Today, we're doing a complete breakdown of ASC 842. We'll cover the scope, core principles, measurement, journal entries, and real interview questions. Whether you're studying ASC, prepping for a Big Four interview, or working in finance, this is everything you need to know. Before ASC 842, companies often concealed leasing obligations, making balance sheets misleading. Imagine a company with $100 million in off-balance sheet leases. Investors couldn't see these liabilities. ASC 842 transforms transparency, requiring operating leases to be on the balance sheet. Understanding this standard will reveal how it enhances financial clarity and impacts corporate reporting. ASC 842 emerged to tackle the opacity of lease obligations that plagued financial statements. Companies previously excluded operating leases from balance sheets, skewing investor perceptions. Now, firms must recognize these as liabilities with corresponding right-of-use assets. This requirement means investors get a clearer picture of financial health, enhancing decision-making. For instance, a company leasing office space for years must now report it transparently, impacting reported assets and liabilities. ASC 842 revolutionized lease accounting by mandating on-balance sheet recognition. Public companies adopted it starting after December 15, 2018, while private companies followed a year later. This standard applies to all U.S. entities, ensuring consistent lease treatment across the board. The core requirement? Companies must recognize most lease liabilities on their balance sheets. This change is pivotal, altering decades of off-balance sheet practices and providing stakeholders with a true picture of financial commitments. The lease accounting model under ASC 842 transforms how leases appear on financial statements. Companies must now show lease liabilities and right-of-use assets, reshaping the presentation of operating leases. This impacts financial metrics like debt ratios and EBITDA, crucial in interviews. Imagine a retailer with numerous store leases, previously off-balance sheet. Now, those leases alter the balance sheet and income statements significantly. Mastering this model is vital for finance roles, influencing lease strategy and financial clarity. Understanding the scope of ASC 842 is crucial because mistakes here can lead to misclassification. A frequent error? Forgetting that leases for minerals or oil exploration don't fall under this standard. Interviewers often catch candidates off guard with this. Knowing what's in and out can save your financial reports from errors. ASC 842 applies broadly, covering most lease categories except for short-term leases and low-value assets. A corporate office lease is a classic example. It requires both right-of-use asset recognition and lease liability on balance sheets. Similarly, vehicle leases must be accounted for, affecting both financial positions and profit and loss statements. Understanding these inclusions ensures accurate financial disclosure and compliance with accounting standards. ASC 842 explicitly excludes leases for natural resources like oil and minerals. This distinction is crucial because these resource leases often follow exploration-specific accounting standards. Biological assets like timber or livestock are also out of scope. Service concession arrangements fall under separate guidance to address their unique nature. Intangible assets such as patents or software aren't considered leases. ASC 842 focuses only on tangible assets, narrowing its application effectively. A lease under ASC 842 is a contract where one party gained the right to use an asset for a time in exchange for payment. Imagine leasing a retail space. You pay monthly for a defined period, but you don't own the property. This arrangement requires recognizing both a right-of-use asset and a lease liability. It's vital to differentiate these from service contracts where no asset control transfers. The right-of-use asset is pivotal in lease accounting. It represents the lessee's entitlement to use an underlying asset during the lease term. When a business leases machinery, this asset is recorded on its balance sheet, reflecting both usage rights and financial obligations. This transparency and asset utilization is essential, impacting both asset management strategies and financial reporting. Recognizing these assets ensures clarity in financial disclosures and compliance with ASC 842. Scope edge cases can trip up even seasoned finance professionals. Short-term equipment rentals are typically excluded due to their brevity, avoiding the full ASC 842 treatment. Leases involving digital licenses, like software, are not covered because they're intangible. However, leasing a tangible office copier falls squarely within the standard. When it comes to mineral resources, like a coal mine, ASC 842 doesn't apply, maintaining its focus on non-extractive leases. Mastering these nuances can prevent costly reporting errors. Imagine a massive $50 million lease flying under the radar on a company's books. ASC 842 forces these to surface, ensuring transparency. This lease accounting model dissects contracts, revealing liabilities and assets. Understand how this impacts financial statements and key metrics. Here's why this matters for investors and managers alike. The lease accounting model is crucial for identifying, valuing, and recording lease obligations. Through our example, Meridian Corporation's $10 million SaaS contract with Acme Incorporated will illustrate each step. This model ensures the $8 million software license and $2 million implementation services are correctly accounted for, impacting financial statements and investor perceptions. Let's see how every step interacts within this framework. Meridian Corporation must determine if its $10 million SaaS agreement with Acme Incorporated constitutes a lease. The $8 million software license implies control over the software's use, qualifying it as a lease. A common mistake is misclassifying service contracts as leases. According to ASC 842, a lease exists if there's control over an identified asset. With this clarity, we move to understanding the lease term. After confirming the lease, Meridian Corporation focuses on its duration. The $10 million contract has a 3-year, non-cancelable term. Ignoring renewal options when there's certainty is a pitfall. ASC 842 includes optional periods if renewal is likely. Now we know the lease spans 3 years, critical for calculating lease liability next. With the lease term set, Meridian Corporation calculates the present value of $10 million in payments over 3 years. This step transforms future obligations into today's dollars. A frequent error is neglecting to discount these payments. ASC 842 insists on using an implicit rate if known. Meridian's calculated liability sets the stage for asset measurement next. Now, Meridian Corporation assigns a value to its right-of-use asset, matching the calculated lease liability from Step 3. A common oversight is omitting initial direct costs from this valuation. ASC 842 requires these costs to be added, so the asset reflects the full economic value. With this asset in place, we turn to recognizing lease expense. Finally, Meridian Corporation recognizes its lease expense. With the right-of-use asset value from Step 4, it's crucial to apply the correct pattern. Many slip by misusing the straight-line method where not applicable. ASC 842 mandates finance leases use an interest method, ensuring expenses align with financial reality. Meridian's careful application preserves transparency and accuracy in their financial reporting. The measurement method you choose directly impacts your balance sheet. A wrong choice can overstate assets by millions. ASC 842 demands precise calculations and disclosures, ensuring everyone understands the financial implications of leasing. Ignoring these can lead to misinformed decisions and regulatory headaches. Let's see how these requirements shape financial reporting. Initial recognition under ASC 842 happens at the commencement date, not when you sign the lease. This timing is crucial due to possible changes in economic conditions. The lease is measured at the present value of payments, which ensures consistent comparison across companies. The discount rate is another key aspect. Use the rate implicit in the lease if available. Otherwise, use your incremental borrowing rate. Remember, if a lease term is under 12 months, you might exclude it, simplifying accounting for smaller leases. Subsequent measurement involves reevaluating the lease when certain triggers occur, such as lease modifications or changes in the discount rate. Although the lease liability might adjust, the right-of-use asset's depreciation remains on track. It's crucial to note that fair value changes don't directly affect measurement unless they alter lease payments. Whenever you agree to new lease terms, remeasurement is necessary to ensure your financial statements accurately reflect current obligations. This keeps your balance sheet reliable and transparent. When presenting leases in financial statements under ASC 842, right-of-use assets are recorded on the balance sheet, classified with similar owned assets for investor clarity. Lease liabilities are shown separately or grouped within debt, allowing users to assess leverage accurately. On the profit and loss, lease interest and asset depreciation appear distinctly, keeping them apart from operating expenses. Detailed disclosure notes provide a maturity analysis of lease liabilities, offering stakeholders insights into future cash flow commitments. This transparency is vital for financial analysis. ASC 842 demands specific disclosures to ensure transparency. Firms must disclose the nature and terms of leases, providing insight into strategic commitments. A maturity analysis of undiscounted lease liabilities helps stakeholders assess future cash needs. Assumptions and judgments used in determining lease terms must be explained to build trust in reported figures. Additionally, detailing lease expense components allows analysts to evaluate cost structures and understand profitability impacts. These disclosures are not just regulatory boxes to tick. They are crucial for informed decision-making. Imagine a CFO managing a new office lease involving $3 million in payments over 5 years. By applying ASC 842, the CFO calculates a $2.5 million initial right-of-use asset and corresponding liability, using a 3% borrowing rate. This results in a $600,000 annual lease expense, clearly showing separate interest and depreciation. To ensure transparency, the CFO discloses lease terms, assumptions, and a maturity analysis. This approach not only complies with standards, but also keeps stakeholders fully informed about the financial implications of leasing decisions. Meridian Corporation, a global manufacturing company, signs a 5-year operating lease for its Singapore warehouse. Watch how every accounting event plays out. ASC 842 mandates that operating leases be recognized on the balance sheet. Meridian Corporation records a right-of-use asset and lease liability equivalent to the present value of payments, $1,200,000. This inclusion affects both assets and liabilities, providing a clearer financial position. Each payment reduces the lease liability, aligning with ASC 842's treatment for operating leases. Meridian Corporation credits cash and debits lease liability by $230,000, with the remaining $70,000 expensed, reflecting the asset's consumption. This dual entry impacts both balance sheet and income statement. Interest on the lease liability accrues over time. ASC 842 requires Meridian Corporation to recognize $24,000 of interest expense, calculated on the remaining liability. This ongoing cost impacts the income statement and adjusts the lease liability accordingly. Year-end adjustments ensure asset values on the balance sheet are accurate. Meridian Corporation debits lease expense and credits accumulated depreciation for $70,000, recognizing the consumption of the right-of-use asset. This reflects the asset's wear and tear, aligning with ASC 842 requirements. Consistent with the first year, the second annual lease payment reduces the lease liability by $230,000 and reflects a $70,000 lease expense, maintaining an accurate portrayal of the right-of-use asset's consumption and financial commitment under ASC 842. ASC 842 requires remeasurement of lease liabilities when terms change. Meridian Corporation adjusts the right-of-use asset and lease liability by $50,000 due to a lease modification, ensuring financial statements remain current with contractual obligations. Upon lease termination, ASC 842 requires derecognition of related assets and liabilities. Meridian Corporation eliminates the remaining right-of-use asset and lease liability of $950,000, concluding the lease, with its balance sheet reflecting these changes accurately. Every Big Four and investment bank interview on ASC 842 follows a pattern. Here are the 10 questions that come up again and again, with answers that will make your interviewer nod. ASC 842 is the accounting standard for leases, requiring lessees to recognize nearly all leases on the balance sheet. This change enhances transparency by showing lease liabilities and right-of-use assets. A common mistake is overlooking short-term leases, which can be excluded. Memorize ASC 842 eliminates off-balance sheet financing for most leases. ASC 8242 exists to increase transparency in financial reporting by requiring companies to recognize lease obligations on the balance sheet. Previously, operating leases were often off-balance sheet. This standard ensures investors see all liabilities. Common pitfall: assuming old rules apply. Key takeaway: ASC 842 aligns lease accounting with the economic reality. Lease modifications require remeasurement of the lease liability using a revised discount rate. Key: determine if the modification is a separate lease or an adjustment. Misstep: treating all modifications as separate leases. Remember, not all changes are separate leases. Assess the nature and timing of modifications. Operating leases remain off the balance sheet, with lease expenses recognized straight line. Finance leases reflect asset and liability on the balance sheet, similar to ownership. Trap: misclassifying leases can mislead stakeholders. Tip: confirm lease terms and conditions to properly classify under ASC 842. ASC 842 allows for operating leases to remain off balance sheet, while International Financial Reporting Standards 16 requires all leases to be capitalized. This impacts financial metrics like EBITDA. Pitfall: assuming identical treatment under both standards. Important: understand the lease classification impact on financial reporting. Variable lease payments, like those based on sales, aren't included in the initial lease liability measurement. Instead, they're expensed when incurred. Trap: assuming all payments are fixed. Remember, only include fixed or in-substance fixed payments in the lease liability calculation. Short-term leases, less than 12 months without purchase options, are excluded from the balance sheet. Misunderstanding occurs when treating all as long-term. Critical: properly assess lease terms to determine applicability. Takeaway: short-term leases simplify reporting but require accurate categorization. The initial right-of-use asset equals the lease liability, plus initial direct costs and prepaid lease payments, minus lease incentives received. Pitfall: forgetting adjustments for direct costs. Memorize: initial asset reflects total lease commitment, adjusted for upfront payments and incentives. CFOs must disclose lease term assumptions, discount rates, and qualitative factors affecting leases. This includes risks and management strategies. Common oversight: omitting qualitative disclosures. Essential: disclosures ensure stakeholders understand lease impact on financial statements, beyond numbers alone. Lease modifications can change the lease term or payment amount, impacting both the balance sheet and income statement. Common error: not updating cash flow projections. Important: remeasure lease liabilities and right-of-use assets to reflect modifications, ensuring accurate reporting. ASC 842 revolutionized lease accounting by requiring lessees to recognize most leases on balance sheets, enhancing financial transparency. It applies broadly, with exceptions like natural resource leases. Key definitions include conveying control of an asset over a specified term. Short-term leases, defined as those under 12 months, may avoid balance sheet recognition. Understanding these basics is crucial for evaluating the standard's scope and purpose effectively. Mastering the core model and measurement in ASC 842 is essential for accurate lease accounting. Lessees recognize a right-of-use asset and a corresponding lease liability, with the asset initially measured at cost. Lease liabilities reflect the present value of payments, using the implicit or incremental borrowing rate. Classification impacts financial statements significantly, and reassessment is necessary for modifications. These principles guide precise measurement and reporting practices. For interviews, understanding ASC 842's intricacies is vital. Misclassifying leases can skew financial metrics. Unlike International Financial Reporting Standards 16, ASC 842 retains classification differences that can alter financial results. Disclosures demand comprehensiveness for clarity. Right-of-use assets undergo impairment testing, similar to other assets. Choose the right transition method to manage initial adoption impacts effectively. Identifying embedded leases and managing modifications are crucial for maintaining compliance and accuracy. That's your complete guide to this accounting standard. If this video helped you, please like and share. It genuinely helps us keep creating content like this. Drop your standard requests in the comments. Subscribe to Candy Mentor for more accounting and finance videos.